Interested in learning about price-to-earnings ratio? This metric, also known as P/E ratio, gives investors a quick valuation of a stock. It's a very common metric that helps you understand if the company is currently over or undervalued in the market. Today in this video, let's talk about the price-to-earnings ratio P/E ratio. Be sure to watch until the end. It'll only take 5 minutes and you'll gain a thorough understanding of the P/E ratio. P/E ratio is a valuation metric that compares the stock's current price to its earnings or profit. It tells you how much of a premium you are currently paying in order to gain exposure to that company's profits. The price-to-earnings ratio can be used to help understand whether the market is currently placing a high or low price on that stock based on how much money and profits the company is generating. In general, stocks with a low P/E ratio, something around 10, would imply the stock is currently cheap, whereas stocks with a high P/E ratio, say 50 or greater, implies the price is currently expensive relative to the profit that it makes. Let's have a look at how you can calculate the P/E ratio. The formula is the price per share divided by the earnings per share. Now, to get a better understanding of earnings per share, the output from the P/E ratio calculation will result in what's called a multiple, something like 20 times. If you ever hear somebody referring to a stock's multiple or earnings multiple, this is what they are talking about. So now let's do a quick example. A hypothetical company, Bill's Bike Shop, currently has a stock price of $60 per share and has an earnings per share of $3. To find the P/E ratio, we divide $60 by $3 to find the Bill's Bike Shop has a price-to-earnings ratio of 20 times. What this is telling us is that the market is currently valuing the shares of Bill's Bike Shop at 20 times the amount of their yearly profit. So if you were to buy shares in Bill's Bike Shop, you would be paying 20 times the amount that they generate in profit for the year. This ratio also implies that it would take 20 years at current price and profit levels for Bill's Bike Shop to make enough money to pay back all the shareholders in full for their shares. P/E ratio really shows its strength when you use it to compare different companies within the same industry to get a better idea of how each company is being valued. Let's compare it to companies here. Bill's Bike Shop and Sam's Scooter Company, both of which provide alternative means to transportation, so we can consider them to be in the same industry. From before, we already know that Bill's company has a price per share of $60 and an earnings per share of $3, giving us a P/E ratio of 20 times. Now for Sam's Scooter Company, they currently have a price per share of $75 with an earnings per share of $5. You may be inclined to think that Bill's Bike Shop is a better value, because the share price is only $60 versus the $75 for Sam's Scooter Company. But share price alone does not tell the full story. When we calculate the price-to-earnings ratio for Sam's Scooters, we find that the stock has a P/E ratio of 15 times. So what's going on here? Even though Sam's Scooters has a higher price per share, they are also generating more earnings for the shares outstanding. What we see is that when we compare the two companies and in apples-to-apples sense with P/E ratio, we find that Sam's shares are actually a better value since the company is more profitable. Even though Sam's Scooter shares are $15 more expensive, they actually give you the right to more profits than Bill's Bike Shop does. You have the right to $5 per share with a profit, instead of only the $3 per share in profit the Bill's Bike Shop offers. This is really the key to understanding what P/E ratio tells us. You should know that the price-to-earnings ratio is really only useful when comparing companies within the same industry, as different industries will have different standards when it comes to P/E ratio. It would not make sense to compare McDonald's P/E ratio to Amazon's P/E ratio, for example. This is because expectations and growth rates within the restaurant sector like McDonald's are very different than the expectations for a technology company like Amazon. McDonald's might see more consistent profits, but at a lower growth rate, whereas Amazon's profits are expected to grow much faster, but have the potential for volatility. It would be a much better idea to compare Amazon's P/E ratio to another tech company like Apple, to get an idea on the valuation of each of those companies. With that being said, remember that using P/E ratio for comparison is really only useful for companies that operate in similar markets and similar industries. Finally, let's have a look at where we can find P/E ratio without doing any of the math. That's all for today's sharing. If you found it helpful, please like, bookmark, and subscribe to my channel for more free short videos. Thank you for watching, and see you in the next video.